Okay, so we'll start with a brief recap. That is for the previous terminology, charts, and everything we did last lecture. Uh, People can sign up on that attendance form so that we record your attendance, especially the people who didn't come to last lecture, so that we can add you to the Piazza and Canvas. Um, so yeah, wait for a minute. So we talked about terminologies, mainly the bid, offer, size, and spread are very important here. Bid is the highest price which you are willing to buy something for. Offer is the lowest price you are willing to sell for, and size is the amount of stocks you are willing to sell or buy. Spread is the difference between bid and ask price. So here it was one um, in the diagram in the chart we have, and then let me start this. Okay, and then it was about conveying the situation. So hitting the bid and lifting the offer respectively means that you are agreeing to the buyer or seller price, which is already on the top of that market depth. Market depth is all this list of orders that people have placed. Next is market making. So in order to make a profit out of existing market without like investing money as a net, you will place your buying order at the highest price, selling order at the lowest price, and the spread between those two helps you gain a profit. So that was what market makers does. Then we have charts. Charts would be mostly three types. Line charts simply indicates your closing prices over time. Candlestick charts does have a little more indication through that figure, low price, high price, closing and open price. But you do need coloring coding because that's just a simple like a line with basically four parts. But in the bar chart, you do have like a left and right situation also. So basically left mark denotes open, right denotes closed. But we can still have a color there so that the stocks can be like analyzed well through the chart. So that was charts, then some additional terminologies. Then I hope like you can just keep trying that game if you like to. That's pretty interesting. It builds an intuition of how you should play a trading game or like a strategy. Then I think we talked about fair value of stock. So the one you think is a fair value of stock is the intrinsic value. The models that you build, they give a value that's the theoretical one, and your model may not be very good. So an ideal model would give like a true value, and then if the market price becomes a true value, that's efficient market hypothesis, which generally says that that alpha generation is impossible. You can have all the information in the existing period incorporated into an alpha, but still it's not possible to generate a consistent alpha, right? So that's one, and that's as a result of market inefficiencies. So they can be of various types, mostly human sentiment, emotion, or high transaction costs, lack of liquidity. Those can be the reasons. Then next is the key parameters. So I think in today's session, we also had some parameters which we are considering. But what we covered in last lecture was these two, mainly EPS and price to earnings. So EPS is given by the formula here, and price to earnings is the stock's market price divided by EPS ratio. So that gives you a sense of how the company is performing overall, like how much profit you are making, how much dividends they are giving. All those factors are incorporated here, so these two are very important. I think that was it. This was just an example of calculation. And now I think we'll talk about options. So Megha here will do that. Any doubts in like general about this? Okay. Let's just yeah, no, yeah.
Hi, I'm Megha. I'm a junior. I'm an applied math major, data science minor. I'm gonna talk about options today, and maybe how to value them, and then in the end, we like do a small code sample as to how you could code a binomial tree. So it's going to be a lot of information and it's very complicated, but all of this is going to be used and revised eventually at some point later in the quarter. So, and we'll share the slides. So to start with, so last time we spoke about stocks. So do you always have to own a stock to kind of invest in the market? And basically that's where the idea of options and derivative market comes from. So you don't always have to own stocks. You can always like short sell it or buy, which basically means that you're doing the buy sell transaction in reverse. Okay, so let me do the buy sell action in the reverse method. So it basically means that you tell somebody that you're going to buy the stock, but you don't, that you're going to sell them the stock, but you don't own it yet. So technically, if you want to sell something to someone, you have to have it, right? So short selling means you don't have it, but you promise someone that I'm going to sell it to you at this price. And you hope that if the price today is, for example, 100, and you tell someone you sell it to them for 110, for example, and then you think that the price is going to go to 90 on the day that you have to sell the stock to that person. So you tell them that I'm going to sell the stock to you, so it's technically borrowed. And then on the day that you have to sell it, hopefully, if it does actually cost $90, then you buy it at 90 and sell it at 110. So instead of making a $10 profit, you're making a $20 profit. We'll go into more examples of this later if that didn't make sense. And then so that's what you need to have an insight of whether you could make more money using the same amount of money that you have. So as I said, that's where the concept of derivative markets comes from. So a derivative is a security whose value depends on the value of some underlying security. So for example, in our previous example, the value depended on the stock. So in a future or a forward contract, you're not actually buying the stock. You're just, I don't know how to term it, but you're basically just saying that, okay, you're signing a $20 contract for the price of the stock. So you're not actually, for example, there's a lot of stocks that are really expensive. Like there are some stocks that go up to like $10,000 per share. So if you don't have that much money, you can always sign a contract to estimate the future price of that share. And you basically have a premium price to buy the contract. So you have a lot of options like contracts, future contracts, options, swaps, etc. These are all kinds of derivatives. So where we have a stock market, there's something completely called a derivative market, and a lot of hedge funds only trade on derivative markets as well, which is basically options and futures. And it basically means that you agree to buy or sell an asset at a specific price at a specific date. So that's basically the contract that you are selling. And okay, so why would you trade for an option rather than a stock? So you have more flexibility compared to even a future. So what we discussed in the previous slide was a future, and options are more flexible than futures. And now we just talked about options. So they provide you with a greater leverage than stocks because you have more control over the asset with less money. And then that's why technically you have lesser risk because the amount of capital that you are putting into is it can be more, but it's definitely usually lesser than how much you would actually invest to buy a share. And okay, so now to go into options. So it gives you the right, but not the obligation. So the person who owns the option can decide whether they want to go ahead with it at the termination date or the expiration date, or they don't want to. So it is the right, but not the obligation to buy or sell a given security, which can be your stock, at a given price, which is basically called the strike price. So as I said in my example before, 110 would be your strike price, 100 would be the current price, and then a premium is what you pay to sign the contract. So a lot of time, hedge funds make money through the premium. So they would, for the same stock, there's two kinds of options, call and put. So they would either buy an option or sell an option. And then the premium is what the two parties who either buy or sell or who sign the contract decide. So for example, they sign a 58 cents premium on the buy and they sign a 50 cents on the sell. Sometimes the only profit they end up making is the 8 cents if they buy one and they sell one at the same price. We will go over that later also, if that is confusing. So the three main important things for an option are the strike price, which is the price at which you decide to buy or sell at the future given time, the expiration date, which is the date at which your contract expires, and the premium which recovers. So there's the European markets and the American markets follow two different kind of options. So most Asian countries follow the European option, and so the difference between a European option and an American option is that an American option you can exercise at any time. So, for example, you have for 20 days, even at 10 days, you could, at a 10-day limit, you could be like, okay, I would like to sell my option now. But for the European option, you have to stay till the expiration date. Okay, so a put option and a call option are the two kinds of option. So a put option is the stock of the option would sell one share at a future time at the price K. So the K price is your strike price. So at the future time, your payoff from the option would be the strike price minus the current stock price. If the strike price is greater than the stock price, and zero if your strike price is less than the stock price today. So basically means that if you have $100, if the stock price is $100 today and the strike price is $90, then your K would be $90 and your ST, which is the current stock price, would be $100. So right, if that was the case, then your payoff would be $0 from the option. But at the same point, if your strike price when you sign the contract was $110, then you would basically make $10 on the option. And a call option is the opposite of a put option, basically when you have the right to buy the option at the given price which is the strike price, and it works the opposite way for it. So for a put option, it was K minus the stock price, but for a call option, it is the strike price minus the stock price minus the strike price. So if we take the same example, then it's a call option where the current stock price is $100 and the strike price is $90. Then it would be ST minus K, so 100 minus 90. So in the put option, we did not make anything. We made $0 because it was 90 minus 100, so it was 0. But right now it is 100 minus 90 in a call option, so you make $10, which is your current stock price minus the strike price. And if it was $110, the strike price was $110. Then in the put option, we made $10, but in a call option, we would basically not make anything. So in the finance world, buying and selling is usually called long versus short. So if you buy a call option, so these are graphs for the payoffs for whether you would buy a call option or sell a call option or buy a put option or sell a put option. So the first one, which is this one, you are going long on a call option, which is basically when you buy a call option, your payoff would be 0 until the strike price. And then as the stock price increases more and more until your expiration time, your payoff increases. So this comes basically from the formula that we saw in the previous slide, which was ST minus K. And then if you would go short on a call option, which is if you would sell a call option, that is be the other side, be the other party, then your payoff would be 0 till you reach the strike price. But then as more and more the stock price increases, the more and more money you would lose, because that's the amount of money that you would lose because the other side, which is the long side, is going to buy it for that much. So people who usually sign, who go short on call options are the people who are trying to make money on the premium. So because technically they're making $0 till the strike price. So what they're actually trying to make money is on the premium. And on a put option, it works the opposite. So if you go long on a put option, you keep having a profit or a positive payoff until you reach the strike price. And then once you reach the strike price, then you have a 0 payoff. And then similarly, if you go short on a put option, which is you sell a put option, your payoff is negative until you reach the strike price, and then it is 0. So once again, a lot of people who go short on options are trying to make money on the premium. So if you see hedge funds, a lot of high frequency trading funds, they are the ones who usually go short, and we, like the common people or like individual traders, are the ones who go long because if they predict that it's not going to reach the strike price, then we're going to make 0, but we have already paid them the premium to sign the contract. So they're going to make the premium. Does anybody have any questions about that? Yeah. So for call options, the lower your strike price, which was RK, related to the current market price of the stock, the more valuable is the option because you get to purchase the stock at a lower price and sell it at a higher price. And conversely, for a put option, if the higher the price, the lower the strike price can make the option less valuable. So you would actually prefer a higher strike price. Okay, so this is basically binomial models. This is what we're going to cover for the rest of the class. So binomial models, have you guys heard of the Black-Scholes model? So the binomial model is basically step 1 out of maybe 5 to 6 steps to reach the Black-Scholes formula. And the binomial model is like the basic building block. And we're going to cover like all these factors and make steps before we reach thresholds later in the model. So a binomial model is basically a binomial tree, and it has two nodes, and every node has two directions, which is either the stock price goes up or the stock price goes down. And it keeps going down till basically how the time frame that you decide for the tree node. So we use the binomial model to price options. So if I am a hedge fund and I want to decide how much I want to buy or sell the option today, depending on what I predict the future price would be, first I would come up with a risk neutral probability, which I would, okay, so you would have an algorithm that will tell you what the up probability and the down probability for the stock is. Then you would use that up and down probability to calculate the risk neutral probability for the tree. And then when you basically reach time 3 in this tree, for example, you would calculate the payoff for the option depending if it was a call or a put. So this is all an imaginary scenario which is built upon what you think would be the up or the down probability for a given stock. And then you would use this tree to go back. It's like a backward process, which we will do it later, to calculate the original estimated value of the option in a different tree. And that is the value that you would sign your contract on. So this is basically how hedge funds or individual traders come up with the price. So for example, we decided the strike price or the price of our option was $80. So how did you come up with that? So this is what they basically use to come up with that price. So this is just to explain the tree further. So that is P, which is the risk neutral probability that you calculated. So that's S0. So you would multiply it by the up factor. For example, your S0, which is S0 means the current value of the stock, is 100. And for example, your algorithm told you that U, which is the probability that your stock, the value that your stock would be if the stock went up, is 2. Twice, which means twice. So if your U is twice or 2, and your down is half, then at time 1, it will be 100 into 2, which is 200, or 100 into half, which is 50. And the probability of that would be P and 1 minus P. And then similarly at time 2, again you would do 200, which is the first up probability, multiplied by 2 again. So that would be 400. So U squared S0. So the tree would keep going on and on like that for how many other time intervals you calculate. So once again, so for an American option, you could sell it at this time, or this time, like any of these places. But in a European option, you would have to wait till time 3, if that is the time that you decided while signing your contract, which is the expiration date. So for example, your expiration date is after a year, and you said that every time interval is a month. Then in a European option, you could only sell it after a year, but in an American option, you could sell it every month because that is your time interval between the year. Okay, so you guys hear me without this?
It won't go on the Zoom. Yeah, it is okay.
So replicating portfolio is, so now you guys must have heard about what a portfolio is. So a portfolio is in general in the stock market when you would create a list of all the stocks you want to buy and the quantity of every stock you would like to buy. So a replicating portfolio is what you create to buy instead of even buying an option. So instead of buying a stock, you could buy an option. And then instead of signing an option contract, you could actually create a replicating portfolio that replicates the two scenarios that if you would have signed the stock option, the payoff would be. So the given financial instrument in this case would be your option, and you basically have a risk-free asset to mimic the payoffs of your option. So the portfolio in this case would be A and B, where A is the quantity that you would invest in the stocks, and B is what you would invest in a bond. So does anyone want to share what a bond is? Oh, yeah. Yeah. It could be the government or even companies. Sometimes some private companies you could sign a bond with. So a bond is when you invest money into a certain contract. A bond is also a contract, and it pays you instead of the price going up or down, which goes in stocks. For bonds, it's basically they pay you interest on the amount of money that you have invested with them every month or every year, depending on what the bond says. So, for example, a lot of governments, when they need money from the public, they let you sign a government bond. And a lot of people sign bonds because the risk in a bond is extremely minimum, because after all, it's the government, they are going to be able to pay you back. So if you would sign $1,000 bond with the government and they told you that every month we would give you 0.1% or 0.01% as interest, so you have interest income without having any kind of risk. So a replicating portfolio for an option is when you put A value investment in the stocks. So if A was 2, then you would buy 2 stocks. And if the bond was 2, then you would buy 2 bonds. So like that. So it is a portfolio that you create that would mimic the option by buying A in stocks and B in bonds. So you can create, so how do you link this to a binomial model? So you would create a replicating portfolio for each node at the binomial model. So as we saw, it was US0, DS0, U square S0. So these are your nodes in the binomial model. And you would basically try to create a replicating portfolio at every node. So if you have to go back, if you, as I told you, that at time 3, you would calculate your payoff, whether it was a call option or a put option, depending on your strike price. So now at time 2, at all of these, you would try to create a replicating portfolio, which would give you the same payoff as this option would give you, but using bonds and stocks instead of signing the option contract. And then why would you, so this is what we covered, that you would invest in bonds, because you actually want to see if the stock is beneficial. For example, the bond is telling you that, okay, we're going to give you 0.1% return, not 0.1%, 0.1 or 10% return. Interest, nobody gives you that much interest, but that much interest on your bond. And if your stock actually ended up giving you only maybe 2%, then why would you invest in a stock and not just put your money in a bond? Because you have fixed 10% income. So this is a replicating portfolio. Imagine you have an option to buy a stock at a certain price, which is C0 in the future. So you can create a replicating portfolio with stocks and bonds to pay off this option. So if the initial price of the option is higher than the fair value or the theoretical value, which is D0, we will see how this is calculated in a tree on the next slide. You could basically sell the overpriced option, but use your money to invest in the replicating portfolio, which is buy additional bonds with the rest, because you technically have more money because your C0 is higher than B0, which basically means you have $100, but the fair value of the option is $80. So that's the price that you came up with to sign your contract. So you would sign it for $80, and you still have $20 left. So you would invest that in a bond, and the bond would give you 0.1%, for example, interest, and you would make money on your option. Oh. And then now I'm gonna show you guys how, oh, sorry, yeah.
To explain the slide again.
This slide or this
this
slide?
one.
Okay. So so imagine C0 is your option to buy a stock at a future time. Okay, and using your tree in the previous step, where I told you that you would, using the back of your tree, when you go upwards, which we will see in the example I show you, you calculate V0, which is the fair value of your option. So as I told you, that is how people or companies come up with the value that they're signing an option with. So on the market, you have multiple prices to buy an option and multiple prices to sell an option. The same way that he showed a table for stocks. So how does an investor or somebody come up with the price that they want to sell or buy the option as? So that is called the fair value, which is the value you think is the optimum or optimum value to currently buy the option. So that is my C0. So we're on the third bullet point right now. So C0 is the initial price of the option, but V0 is the price you think is supposed to be the actual price. So you could sell the option. So for example, my C0 is $100, but my V0 is 80. So I think the fair value of the option right now is $80, but somebody is ready to sign the contract with me at $100. So I would go for buying the overpriced option, but I think that, and I would buy it for $100. So I'm not giving the $100, somebody is giving the $100 to me.
You're selling for higher than fair value.
Yes, you're selling for higher than fair value. So you can do all of these things. You could either sell for a higher value, you could buy for a higher or a lower value, or you could buy at the equal value. But at the equal value, you would make no profit, which is called arbitrage, which is the risk-free profit. I will talk about this after we draw the tree, because then you all will know what I'm talking about, because right now everything is just a mix of everything. So now you could basically sell the overpriced option, and then a replicating portfolio has stocks and bonds. So the fair value that you think, which is $80, you would put in the stock, because you would buy additional bonds with the remaining 20 you have, which is 100 minus 80. So right now you owe the other person 80 stocks. But they are going to pay you 100 for it. But you think the $80 worth of option is eventually at the expiration time is going to be worth 100, because that is the fair value according to your calculation. You would use the $20 in beginning and basically make extra money using interest on bonds. It'll be clearer, I promise, after the next one.
The other person signed that contract.
Because they, according to their calculation, the value is supposed to be 100. But according to your calculation, which maybe you've done using an algorithm or some method that you have it, you know that the fair value is supposed to be $80. So for example, there's somebody in the market who doesn't know what he learned, what to do in the next step. They would think that it's $100. But because we know how to do the calculation, we know that it's supposed to be $80. So we know that that's supposed to be the fair value in the market right now. So once I draw the trade, I'll show you an example how if somebody was trying to buy an option at a certain price, how you would make this profit from it. Okay, I'm just going to connect my stops. Okay, I'm just going to connect my iPad to show you guys how to do it, and then we could. Okay, so keeps going off again. Okay, so I'm going to explain how the binomial tree works to calculate the fair value of an option. So, for example, you have a call option and the current market price, which is the SCO that we've been using, is $100, and the strike price that you sign the option for is $80. And the rate that your bond gives you is 0.1. So you already know which bond you would invest in basically, and you know how much interest they would give you. So that's 0.1. And as I told you before, if you used an algorithm to calculate what the price would be if the market would go up, it doesn't work like this. This is in discrete time. It also works separately in continuous time. And that is basically the next building block to understanding what the Black-Scholes model is. So for example, you think that your U is 2 and your D is half, which basically means if it goes up, if the stock goes up, the price would be twice. And if the stock price goes down, then it would be half. For example, we're considering 2 time intervals. So right now at the 0th time, the price would be 100. And then if the price went down, it would be half, which is, so it would be 50, and then it would be 200. And then if it went up again, it would be 400. So this is T0, T1, and T2. And then here it would be 100, because basically if it went up, it became twice. So 100 into 2, and then after 200, if on the third interval. So for example, this is month 0, month 1, and month 2. And you consider 2 months, and you consider the price at every month. Then, for example, the price went up in the first month, it would be 200, and if it went down in the second month, it would be 200 by 2, which is 100. And then the similarly for here would be 25 and 100. So this is your stock G. So this is what you think the price will be at different time intervals, at different with different scenarios. So considering a discrete binomial model where it would go up and down only at the given 3 times, and you calculated the up and down which is up to 2.5. These are all the scenarios that you can have. That is, the stock price goes up, then it goes up again, so it'll give you $400. If it goes up and then it goes down, that will bring you back to 100. And slowly, if it went down but then went up, then it would be 100. But if it went down for both months, then it would be 25. This is not how the stock market works in real life. This is just how you reach the fair value of an option if you were only looking at discrete time. It's easier to understand continuous and real value time if you know how discrete time works. Now, as I told you, that using your up and your down factor, which is 2.5, somebody would calculate the risk neutral probability to calculate the probability that these 4 scenarios actually occur. So what's the probability that it's going to go up? It's going to become 400 because it goes up 2 times, or for 125. So to calculate the risk neutral probability, you basically use the up and the down factor. And this is the formula that you have for risk neutral probability that is also used in the Black-Scholes model. So if you do 1 plus your R, which is 1 by 10, and then minus D, which is half, and then you do 2 minus half, you'd basically get 2 by 5. So this basically means that on this tree, the probability from 100 to 200 is 2 by 5, 200 to 400 is 2 by 5. Here would be 1 minus P star, which would be 3 by 5. And then here it would be 3 by 5, 2 by 5, and 3 by 5. So now if you want to calculate the probability that the price goes to 400 after 2 months, you would just do 2 by 5 into 2 by 5. If it goes up and then it goes down, that would be 2 by 5 into 3 by 5. And then 3 by 5 into 2 by 5 for it to go down and then it will go up. And then the probability that the share price is going to be 25, obviously go down for both the months, is 3 by 5 into 3 by 5. So we'll basically use this to create, now we would create the tree that we would do the backward induction that we said that we would do in a binomial tree using the rate that you would earn on a bond. So as we said in the start, this is a call option. And we discussed that the payoff for a call option is K minus ST plus. And right now our K is 80, I think. Yeah, 80. So to go backward induction, so basically this would be our tree. Sorry. This would be our tree because it has these 4 time intervals. So this would be the fair value that you want to calculate of the option at time 0. So using the probability that you think that these 4 prices would be and the strike price that you're going to sign the contract for, you would go back in time and see what the fair value of the option today would be if this is what the probability you think is for the option price to go either up or down. So for this one, now we basically use the K minus ST formula. So when we saw here, it's 2500, 100, and 400. So if we have to do 80 minus the given stock price, it would be, wait. It's ST minus K, sorry for that. So if it's 400, then it would be 400 minus 80. So that would be 320, and then 100 minus 80, 20, 100 minus 80, 20 again, and then 0. And now we would use backward induction using the rate of the bond to calculate what our fair value would be. So to do this, you basically take the risk neutral probability that we calculated here. So your risk neutral probability for going up is 2 by 5 and for going down is 3 by 5. So here I would put 2 by 5 and then 3 by 5. So how you would calculate the fair value of the option at time 1 would be 320 into its risk neutral probability, which is 2 by 5, and then plus 20 into the risk neutral probability at this given time. And then now you're assuming that your extra money, which in this case you can think is $1, you would multiply it by the rate. So you're doing a backward step to calculate if this is the price right now. If you were to invest in the bond, how much would you need? So you multiply it by 1 upon 1 plus R. So when you basically calculate this, which I've already done, you get 1400 upon 11. And then when you do the same thing here, which is 20 into 2 by 5 plus 0 into 3 by 5, and then multiplied by the opposite of the rate, which is 1 plus R, because you're going backwards in the step. So instead of multiplying it by 1 plus R, you're doing multiplied by 1 upon 1 plus R. On this step, you would get 80 by 11. And then you would do the same thing again for all the time periods. So it's not wise to do it by hand if you have, because right now we're considering only 2 time frames, but in a lot of cases, it's much more than that. For example, if you sign the contract period and you consider the time period to be 1 month at every step. So that's why we will write a code later to basically see how this works. So this price comes up to basically 6080 on 121 after doing the whole calculation, which is about $15.24. So you basically think that the fair value to sign the option right now would be $50 with the up probability of 2 and the down, if the up value of 2 down value of half and the risk neutral probability that it goes up of 2/5 and it goes down of 3/5, you would say that the fair value of the option today is $50 and the strike price is 80. So basically the extra $30 approximately you would put in the bond because you signed the contract for 80. So to give you an example of that, for example, the current price of the option that somebody is selling it to you for today is $2 less than the V0 that we calculated, which is 52. So 52 is what you think you would buy the option for, and somebody is selling it to you for $2 less, which is $50. So to get an arbitrage or a risk-free profit, what you would do is you would buy the option and sell the hedging portfolio. And the portfolio is A, B, A in the value of stocks, B in the value of bonds. And so our hedging portfolio right now would basically have 1 in the bond value because that is what we used, 1/1 plus R, where 1 was the value of our bond, while going back in our portfolio. So what we would do is, for example, your trading strategy is minus AT, which means the amount of stocks that you have at time T, minus BT, and then plus 2. So what happens is at time 2, you have your A2 with the stock value, and then your bond price. Okay, so I don't think I told you guys this, but you would buy the option and sell the hedging portfolio, which means you would do negative of A and negative of B. That is go short, what we sell in the start. So you would basically go short on the portfolio, which is you would sell the stock and sell the bond and buy the option. And when you do this, you basically make $2 because you are going, it would be negative of the stock, negative of the bond, and with the extra $2 that you had, you bought 2 of the bond. So it would be negative of the stock, negative of the bond, and then plus 2 of the bond. So you would basically, and then the bond price would go up by 2 because your time period is 2. So you would multiply it by 2. So you would have negative of the stock, negative of the bond, plus 2 of the bond. And then X is your hedging strategy. So it would be plus 2, sorry, minus A plus 2A. So you would basically have a greater than 0 profit, and that's how you would make a profit on this. And then now to go back to the code. So you would initialize the parameters, which is the stock option, the stock current stock price of 100, the strike price of 80, the time to maturity in years, which is 1, and then the rate, which is 0.1, and number of time steps is the number of times you went down in the tree, which is 2. Yeah, it's recorded. And then the up factor of 2 and the down factor of half. So you would basically, so Anuj and I wrote this code this weekend to basically explain what we did in the tree. So I'm going to explain line by line what is happening here. So you put in all your factors that we discussed in the last slide for the tree, and then you basically tell it the type also. So is it a call option or a put option? And then the Q here is basically the risk-free, risk-neutral probability that we calculated by using the formula 1 plus R minus D upon U minus D. And then the discounting factor to go back in the tree, what we used was 1/1 plus R. So you'll put that. And then on this step, we're initializing a zero numpy array that basically puts in all the values of your tree as an array. And then you basically go over the entire time frame, which is if you said n is equal to 2, we had 3 nodes in our tree. We had 3 steps in our tree for 0, 1, and 2. So if our n is 2, then this loop would run 3 times because you have 0, 1, and 2. And then this Sj basically calculates the value of the stock at every node by basically doing the up factor into the current position in the tree and the down factor into the current position in the tree. And then, so this is basically the ST tree that we created, which is the first tree. And now to create the second tree, again, we initialize an empty array. And then again, once again, going in the range of all the 3 nodes, because again, 0, 1, 2. So that means 3. So 2 plus 1 would be 3, because right now we're inputting n plus 2. If the option type is P, which we would put in our function up, then the payoff is the max between 0 and k minus st. So this is basically what we did in our tree as well. So if you remember in the second tree, on the bottom step, depending on whether it was a call option or a put option, for us it was a call option, we used the formula to calculate the 0, 20, 20, and 320 by subtracting the strike price. So depending on whether it's a put option or a call option, it will calculate what the price of the stock is on the last row. And then this loop would basically go over n minus 1 steps, which basically means since using whether it was a call or a put option, we already calculated the price on the lower level. We're using the first level and the 0 level. That's why n minus 1, because you just have to go to 0 and 1, and you don't have to go to 2 because you've already calculated that value. And it goes over that value to calculate before the discounting factor, the value S. So basically what we did was the stock price into the up probability multiplied by the risk neutral probability. So it calculates that, and then it discounts it by using the discounting factor, which is 1 upon 1 plus R. So this is what we did in the last step of our tree, where we multiplied 2 by 5 into the price, and then 3 by 5 into the price, and then multiplied by 1 upon 1 plus R. And then it uses the whether it's a put option or a call option, again at the next step. And then you basically return C0, which in your array is the first value, which is the first value on top of the tree, which is your risk neutral value. So for example, when we calculated an R tree, we got 50.24, something like that. So if we put the same values in our code, you get 50.3. Yeah. R? Oh, R. This R? Okay, so this is the interest rate. So this is R for rate that the bond is giving you. So in our replicating portfolio, we're investing in stocks and bonds, and the risk and the rate that the bond gives you is R. So we're inputting R as 0.1. So if you remember the last step of our tree, we did into 1 upon 1 plus R, which was 0.1. So this is that R. So we use this R to create the discounting factor, which is 1 upon 1 plus R. And then the only place that we use the discounting factor is when we want to go backwards in the tree to calculate the previous value. Okay, does that make sense? Okay. Anybody has any other questions? Yeah.
You get to determine U or NP.
Do we get to determine U and V? Okay, so U and V is what I told you, what your algorithm would say, or what you think the price would be if the stock went up or down. It doesn't work like that, right? Because, for example, today the Amazon share is selling for $185. and I tell you that if the share goes up, it'll be for $200. It doesn't work like that, because in the real market, which is continuous time and continuous price, it could be 185.2, 185.4, and you would still consider that as an up price. But when you consider in a discrete binomial model, you kind of predetermine what the price would be if the price is similar. So yes, it is something that you decide. You calculate it. Yeah. Any other questions? Okay, so we're done. I think half an hour. So does if okay, yeah.
Is amplified for keys.
Is and what?
Which one is the time?
The time? Okay. So here. So n is the number of time steps, but t is the time. So for example, I told you our tree could run for a year, and we consider every step to be a month. So n is basically how many months we're considering. Like I could change the n to 12 if I consider the time period as to be that, but this is the number of steps that our tree takes. So n is the number of steps. So if you see in our code, for every step you would have a value, right? That's why everywhere that I want to initialize an empty array, I'm doing n plus 1. Or every time I want to run through the entire array, I'm using n because n is the number of times, is the number of nodes also the tree would have depending on the time. Yeah.
I think we can run that code once, maybe like.
You have it?
Yeah.
I have it on. Yeah.
Cool. Okay, so yeah, like same code, but I'm just trying to run it here. So we have S0, initial stock, K is 120, T is 1. Now, this thing, right, option type, OPT, if you put call or put, so that's the if case. So when running here, I'm putting P, which is put, and then the function, since so function is defined in the second cell, first cell is the values of all those variables. So let's like try to run it. Okay, and tapping this, that gives, what is that?
No, we used a call option.
Okay, so when you put that,
No.
maybe
That's
the
80.
values, yeah, that's the thing. So you can like try changing values and see how the output varies. Specifically, like so here you just saw like we did call option with 120. That would be so bad because your like strike price itself is more than the initial price of stock, like 100. So that doesn't make any sense. So here you should have like, when calling, it should have like a strike price like this. So any doubts in this? We were trying like a bunch of methods, but yeah, that's what best works. That's also taken from like a YouTube video. We can also share that, like the original person who like tried to code this. We like little modified this so that it works out well for us. Okay. So another announcement. Next class would be remote. I will share the link on Piazza for the Zoom that you need to join. And for the following week, it would again continue in person here. Second, I think pre-lecture quizzes won't work out too well because like we are covering very new stuff. So maybe sticking it to post quizzes would be it. We'll just like merge the grades of like pre-quiz and post quiz is just like 56% together. So whenever we post, we'll make an announcement. For this one, we'll probably post soon. So please try to attempt that one. You have multiple attempts. And we'll share slides.
And you can use the slides and even ChatGPT, but we'll see to it that ChatGPT doesn't get the answers correct for all
Yeah.
questions because we'll try it ourselves first.
Right. So for first one, you might get correct answers, but like beyond this point, it might get little tricky because that's the major part of grades. So like we just ask you that you go through the slides seriously. That's it, and it would help you answer the questions. So that's it for now. We'll share the recording for the session just before this. So try to go over that because that's helpful for your project. So yeah. And then there is food behind. There's a lot of it, so try to finish it up. Yeah.